Ever wondered if all debt is bad? What if we told you that some debts could actually be beneficial for you? In the intricate world of finance, the word debt often sends shivers down the spine, sparking anxieties and misunderstandings. But it's essential to differentiate between good debt and bad debt to make savvy financial choices. Our guide in this exploration? None other than the esteemed financial educator and author Robert Kiyosaki, who underscores the significance of grasping the subtleties of debt. Our journey today is to unravel the mystery of good debt, drawing insights from Kiyosaki's wisdom to steer not just millennials but anyone seeking to make prudent financial decisions. Good debt, as Kiyosaki elucidates, is a strategic financial lever that, when pulled wisely, can amplify your overall financial health. Unlike its counterpart, bad debt, good debt holds the promise to bolster your wealth and yield income. Intrigued? So let's dive into what good debt actually is and how it can be a tool to increase your wealth. Good debt, in simple terms, is a debt that can help you grow your wealth. Now you might be thinking, how can debt, something that is generally seen as a financial burden, aid in wealth growth? The answer lies in the strategic use of borrowed funds. Financial guru Robert Kiyosaki describes good debt as a powerful tool, a tool that, when wielded wisely, can enhance your overall financial well-being. Unlike its counterpart, bad debt, which can cause financial strain, good debt has the potential to boost your wealth and generate income. So the distinction between good and bad debt isn't about the debt itself, but rather how you use it. It's about the impact the borrowed funds have on your financial situation. It's about making your money work for you, not against you. Now that we know what good debt is, let's look at its key characteristics. Good debt has certain distinguishing features that set it apart. First and foremost, good debt is typically tied to investment in income-generating assets. We're talking about rental properties, businesses, or investments in stocks and bonds. The income from these assets should outweigh the cost of the debt, creating a net gain. Secondly, good debt should create positive cash flow. This means the income generated exceeds the interest and costs associated with the debt. The surplus can then be reinvested, saved, or used to bolster overall financial stability. Finally, good debt involves strategic borrowing. This means taking into account factors like interest rates, terms, and potential returns on investment. It's about borrowing money with a clear plan in mind, ensuring that the debt serves as a stepping stone to financial growth rather than an anchor weighing you down. Understanding these characteristics is crucial. Now let's explore some examples of good debt. Real-world examples can make the concept of good debt more tangible. Let's dive in. First, consider real estate investments. Buying property to rent out is a common form of good debt. It's an income-generating asset where the rental income can cover mortgage payments and even provide additional cash flow, leading to wealth accumulation over time. Secondly, entrepreneurial ventures. Taking a loan to start or expand a business can be seen as good debt, provided the business generates profits that surpass the loan's costs. Successful entrepreneurs, as Kiyosaki often points out, use debt strategically to fuel their ventures and achieve substantial returns on investment. Lastly, education. While student loans often get a bad rap, they can be a form of good debt if the education leads to higher-paying job opportunities, career growth, and increased earning potential. This aligns with Kiyosaki's principle of investing in self-education for financial intelligence. These examples illustrate how good debt can work in practice. Let's wrap up with some concluding thoughts. Good debt, when understood and used wisely, can be a powerful tool for financial growth. It's a concept that, when mastered, can turn the tides of your financial journey, transforming debt from a burden into a stepping stone towards prosperity. Robert Kiyosaki's insights remind us that good debt is not just about borrowing, but about making calculated decisions to invest in ventures that yield positive returns. It's about leveraging borrowed funds to create wealth and ensuring that your debts are working for you, not against you. Remember, not all debts are created equal. The distinction between good and bad debt is more than just a financial nuance. It's a fundamental principle that guides successful financial planning. Understanding this difference is your first step towards financial prosperity. So approach debt with wisdom, utilize it strategically, and let it serve as a catalyst for your financial growth and stability. Remember, not all debts are created equal. Understanding the difference between good and bad debt is your first step towards financial prosperity.